I spend a lot of time in my declining years explaining, as you do, the efficacy of owning precious metals to young people. J.P. Morgan Chase, as an example, suggests that precious metals comprise less than 0.5% of the total savings and investment assets of Americans, down, by the way, from a 4-decade mean of 2%. The first lesson there is that if the rest of the things we talk about for the rest of our interview come to pass, it is likely that the market share of gold at least reverts to mean or perhaps overshoots. I'd like your audience to first of all think about what a fourfold increase in demand would do to price. I'm not smart enough to give you the answer to that.
Gold has just blasted through $3,900 an ounce, setting a brand new record. Silver is now sitting just below the legendary $50 breakout, and something historic is brewing. Rick Rule, one of the most seasoned voices in the resource world, says this isn't a rally, it's a reckoning. The U.S. Treasury, he warns, has already claimed the nation's last real money, and most investors have no idea it's happening. While Washington talks about soft landings, the national debt just crossed $37 trillion. Foreign buyers are walking away from treasuries, and inflation is rising again. Central banks from China to Turkey to Poland are dumping dollars and hoarding gold. Rule calls this the start of a dishonest default, not a failure to pay, but a slow destruction of the dollar's value. And if he's right, this could mark the beginning of the most dramatic gold and silver bull market in living memory. Let's break down what's really happening and why Rick Rule believes the world is returning to real money.
But I leave it to you to use your imagination, understanding that prices are set on the delta between supply and demand. Imagine the potential impact of a fourfold increase, which is merely a reversion to mean. Interesting points to ponder. J.P. Morgan Chase suggests that over the last 4 decades, the median or mean market share of precious metals and precious metals related securities relative to all other asset classes was 2%. Now it's 0.5%. So if gold gained enough favor merely to return to its average market share over the last 4 decades, demand for the stuff would grow fourfold. Now they counterfeit 100% of the value of the currency. There was a time when they clipped the edges or they changed the alloy. But governments are much more efficient than they used to be. They steal wholesale as opposed to retail now. If you look at the other promise today, which is to say a U.S. dollar, literally, it used to be a package of dreams painted on a piece of paper. Now it's a packet of dreams clicked into existence. And it's really important, I think, that people know that. Not that the dollar will cease to function as a medium of exchange, but it's an increasingly inefficient medium of exchange if you also ask it to be a store of value, Robert, as you know, but many people don't. It's interesting that you talk about all other forms of exchange as debt, because I think for Americans, debt is the concept that will lead to the best understanding of gold. At the Rebel Capitalist Conference, Gorman's conference, I talked about the math of America. I talked about the fact that our on-balance sheet liabilities exceed $37 trillion, which is now, 120% of GDP?
Right.
In 1982, to put a large number in context, on-balance sheet liabilities were only 32% of GDP. So we've gone from 32% of GDP to almost 130% of GDP. It is estimated by the Congressional Budget Office, not some cranky old libertarian, Rick Rule, but the Congressional Budget Office. It's estimated that the net present value of unfunded entitlement programs exceeds $100 trillion. Now, again, this number in 1982 was about 90% of GDP. Now this number's 350% of GDP. And the math gets a little worse, Robert. I really want your listeners, I know math is boring, but I want your listeners to listen to this. The IRS estimates that the private net worth, the aggregate private net worth of all Americans, is about $141 trillion. And if you add the on-balance sheet debt of the U.S. government with the unfunded off-balance sheet debt of the U.S. government, that number's 130 trillion. So you take what we're worth, 141, minus what we owe, 130, there's only 11 trillion left over. Now, how do we get out of this? What I figure we do is we preside over the devaluation of the U.S. currency. We have a dishonest default. And that's where gold comes in. Gold for decades, for millennium, has been a medium of exchange that's simultaneously a store of value. It's been a place that you go when you don't trust government debt.
Right.
And the math suggests that this is a wonderful time. People on shows like this for a long time asked me when gold was going to move. And I'd scratch my chin sagely, Robert,
Jeez.
and I'd say, well, I think gold's going to move in the year 2000. It's up 9% compounded for 25 years. Gold is two things. Gold is about not getting poor slowly. And if you're aggressive, and if you can afford to be aggressive in silver, which tends to outpace gold when a bull market really truly gets underway, and if you're willing to work hard and invest in the gold stocks or silver stocks, which tend to even outpace the metal, albeit with much greater risk and much greater volatility. Yeah. What you say is very, very, very true. Anybody who looks at the graph of the XAU or any of the gold and silver indexes understands that when you move into a real precious metals bull market, the upside volatility is unlike almost any other financial market on the planet. One of the things I do is I maintain an alternative statement of account as a thought exercise, and I have since the year 2000, measuring my income, my net worth, and my expenses in both gold and dollars. And if you do that, what you're struck by is how cheap food is, how cheap gasoline is. Yeah. If you measure it in the golden constant, price of gold was up $255 an ounce in 2000. You're astonished by the difference in value between your gold savings and your dollar savings. Biggest single experience with political risk that I've ever had personally was discovering a mine that went on to produce 2 million ounces of gold. Sadly, in the People's Republic of California, 7 miles on the wrong side of the California-Nevada line.
Yeah.
And that was an experience I will never forget. I've actually personally been treated better in Congo than California. Basically, I agree with you about the American concept of the rule of law, but I would prefer myself to be in Texas, Wyoming, Nevada, or Alaska, as opposed to the other states. Precious metals bull markets are led by gold. They're led by physical gold, and they're led by fear buyers.
Yeah.
They're led by people.
Pessimists.
Maybe pessimists, maybe not. Just people who don't like the arithmetic of fiat currency denominated securities. I'm one of them.
Yeah, me too.
When the momentum in the bullion begins to expand the producer's margins, the big gold stocks move next. And we've seen that. Franco, Wheaton, Agnico Eagle, they've all doubled in 12 months.
Rick Rule starts with a reality check. Less than 0.5% of all U.S. savings are in precious metals, compared with a 40-year average of 2%. If gold's share of wealth simply reverts to that long-term mean, it means a fourfold jump in demand and an inevitable price explosion. And we're already seeing the signs. Spot gold has surged to $3,950 per ounce, silver to $48.50, both hitting their highest levels in over a decade. The reason? The bond market is breaking, and investors no longer believe the Fed can control inflation without destroying growth. Rule explains that the government's answer has always been the same: print. They used to clip coins, he says. Now they counterfeit 100% of the currency. What was once slow debasement is now digital theft on a national scale. The math proves his point. U.S. on-balance sheet debt, $37+ trillion, about 130% of GDP. Unfunded liabilities like Social Security and Medicare, over $100 trillion, or 350% of GDP. Total private U.S. net worth, $141 trillion. That means the nation owes almost everything it's worth. The only way out, Rule says, is through currency devaluation, a dishonest default that punishes savers. For him, gold is insurance, not to make you rich, but to keep you from getting poor slowly. And silver is your torque, the asset that historically outperforms gold 2-to-1 when confidence in paper money collapses. He outlines how every precious metals bull run unfolds. Gold moves first, driven by fear and distrust. Large producers follow as margins widen. Silver ignites once mainstream investors wake up. Finally, junior miners explode as speculative capital floods the sector. Rule adds that the entire metals market is too small to absorb what's coming. It's like trying to siphon Hoover Dam through a garden hose. Even manipulation, he says, can't stop a structural shift in global trust. With COMEX inventories near record lows and industrial demand for silver surging from solar and EV manufacturing, this setup looks nearly identical to 1979 and 2011, except now the world's reserve currency itself is in question.
At some point in time, that movement, that momentum attracts the generalist investor into the gold space.
Yeah.
And the gold space is so small, it can't accommodate the money. When that happens, leadership goes from gold to silver. And by the way, you will not need Robert Kiyosaki or Rick Rule to tell you when that happened.
No.
It's a truly dramatic event. And then the end of the precious metals bull market is when the money trickles down into the junior miners and the junior producers. And those moves are truly insane. Playing it requires a lot of education. It requires a lot of discipline. I would suggest that probably 85% of the junior miners are valueless. But that 15%, they generate such robust performance that they had legitimacy and even luster to a very rough sector. You described the chain perfectly. Silver will come after when the generalist money comes out into the space. Our mutual friend, Doug Casey, described that event, the generalist money coming into the silver market, as attempting to siphon Hoover Dam through a garden hose. If you really begin to change the balance between the futures market and the spot market, and I'm not saying that'll happen or it won't happen, that's what the shortage is all about. Right now,
wasn't JP Morgan fined for playing games with silver?
You know, people say that the markets are manipulated. All markets are manipulated. It's just that the silver market is so skinny that the potential penalty, I don't mean governmental penalty, I mean market penalty for manipulation, is extremely high. I remember in the decade of the 70s when silver markets were manipulated up because that was the easiest way to manipulate them. And I suspect that trading desks will do that again. JP Morgan amongst them.
Rick Rule's message to investors today is unmistakable. America won't default honestly. It will default through inflation. That means the dollar may survive as a medium of exchange, but not as a store of value. And when that trust finally breaks, the rush into gold and silver will be unlike anything we've ever seen. So ask yourself, are you still holding your wealth in paper promises or in real assets? If the Fed launches another $5 trillion rescue, what will your savings buy 5 years from now? And when silver finally breaks above $50, will you already be positioned or watching from the sidelines? Gold protects your purchasing power. Silver amplifies your upside. And as Rick Rule reminds us, this may be the final window before the general public wakes up. If this analysis helped you see what's really driving the markets, smash the like button, subscribe to the channel, and turn on notifications so you never miss a Macro Edge deep dive. And drop your thoughts below. Do you think the U.S. will devalue the dollar to escape its debt? Or is there still time to restore trust in the system? We'll feature the best answers in our next episode. Thanks for watching. And remember, real wealth can't be printed.